Hi, Emily. How you doing?
Oh, pretty good.
Uh-oh, it sounds like you're finding the course a little difficult, huh?
The 9 a.m. difficult.
No, we'll get everybody through it. So let's just wait a minute here, okay? And
Okay.
see if we get anybody showing up. You weren't here the first class, right?
I was.
You were. Okay, for some reason I don't remember Emily. Okay. So you done the homework and everything, Emily?
I'm getting through it.
Okay, good, good. And you know where to find me for tutoring if you need it.
Yes.
And today we're having a hangout at the school. If anybody wants to stop by and say hello. This is an idea of my boss, and no one ever shows up. So maybe today's the day. Hello, John.
Good morning.
Hey, were you with me Tuesday or when was it? Monday, John?
Yes, I was.
Okay. All right. Well, let's get started then. We only have two people, but we'll get going here. And we're into chapter 2. Chapter 2. So let me share the screen. Chapter 2. Okay. Emily, can you verbally tell me if you can see the PowerPoints?
Yes, I can.
Okay, good. Because once in a while I look like an idiot. I start talking about the PowerPoints without showing them to anybody. Okay, all right, here we go. Chapter 2. Now we're going to look at some financial statements in a little more detail, a couple more ratios, and we'll try to build on that. You're going to see that the balance sheet has a certain section that we haven't covered yet. And we're going to talk about some ratios on solvency, liquidity, profitability. Identify the sections of a classified balance sheet, okay? A balance sheet can be classified. Those of you who took Accounting 110, we didn't really get into this, where we talk about a classified balance sheet, meaning we're going to show current assets and current liabilities. Hey, good morning, Rachel. Good morning, Lizzie. We're just getting started here.
Good morning.
Here we go. The classified balance sheet. Remember that the balance sheet is a snapshot at a point in time. And that question comes up inevitably on the tests in one form or another. In other words, your header has to say something like, as of March 31st, 2020. It can't say for the month of, as it does with an income statement. So to improve understanding, we're going to talk about current assets and long-term assets, okay? Current liabilities and long-term liabilities. So let's see what we have here. Let's take a look at the balance sheet to get started. Your assets, as you can see here, total $61,400. Notice that you have, it looks like 4 or so subtotals. Current assets total 22,100. A current asset is any asset that we're going to chew up within a year, okay? Or the operating cycle, whichever longer, but typically a year. The current assets are always listed in order of liquidity. Listed in order of liquidity. Liquidity meaning how easy it is to turn it into cash. Cash is liquid. So cash will always go first, and then you'll have short-term debts in instruments. These are maybe some bonds that you issued or something. Accounts receivable, notes receivable, inventory, supplies, prepaid insurance, classic current assets, okay? We go from there and we get into the long-term stuff, the fixed assets and some other things. So they're starting us off with a section on investments. Yeah, you would show the stock investments separately, but let's look more detailed on the section where it's got the property, plant, and equipment. Property, plant, equipment. Those are called fixed assets, non-current assets, fixed assets. These are the big ticket items, cost a lot of money, and we're going to have them for years to come, hopefully benefiting from them. And land is always listed first. Land is always listed first. Land is listed first. I don't know why, but it always is. And then after that, you have your building, equipment, trucks, things like that, okay? Computers. And then we come into something called intangible assets. Intangible assets. Intangible meaning you can't see them, you can't touch them, but they're there. An intangible asset is intellectual property, like a patent that you see here. A patent is granted to an inventor who then receives the sole right to benefit from his invention. You invent something, you get a patent, nobody else can try to sell that product or try to duplicate it. So what are we looking at? Current assets, fixed assets, intangibles. Just like you had current assets, you have current liabilities. For some reason, accounts payable is listed second here. Accounts payable is always shown first, but we'll let that go. Accounts payable, notes payable, unearned sales revenue. We'll talk about that when the time comes. Salaries and wages payable. Anything with the word payable in it is a liability, okay? So these current liabilities you see here are going to be paid within a year. Long-term liability could be the form of a mortgage. You went out and you bought a big factory building for $10 million and you took out a mortgage. Well, that mortgage has a current portion, which represents just this current month. The rest of it is part of the long-term liabilities. And again, take a peek at stockholders' equity. When we were in 110, we called it capital, right? We called it capital, or we called it equity. Here, we're going to get in the habit of calling it stockholders' equity, and it will have 3 or 4 components to it. We're just showing you 2 of the components here. Stockholders' equity, common stock, and retained earnings. So what we have here is a company that issued stock to the public. And that stock issue brought them $14,000 in cash. So the common stock number is 14,000, and that number is going to be reported the same every month for the rest of the history, unless they issue more stock, of course. So you have that component of the stockholders' equity, and then you have what's called retained earnings. Retained earnings is an equity account. It has a normal credit. We haven't got up to debits and credits yet, but retained earnings is part of equity. It's a component of it. You started a company on January 1st. There's no retained earnings there because you haven't earned anything yet. At the end of the year, your company made a profit of $10,000. That profit of $10,000 gets moved into retained earnings. You made a profit of $20,000 the next year, your retained earnings just goes up to 30. So think of retained earnings as the cumulative profits and losses of the company since day one. Offsetting that, though, would be any dividends they pay, okay? So we had 61,400 in assets, and it equals the total of liabilities and equity, 61,400. The nature of current assets, we were just saying up to 1 year would make it a current asset. And they're giving you the typical ones: cash, receivables, inventory, prepaids. And the operating cycles, the average time it takes from the purchase of the inventory to the sale of the goods, and then to the collection of cash. Typically, we're talking about a current asset being used up within a year. But if your operating cycle is longer than that, that's the period you want to consider current. One example might be in the world of farming, where you plant in the, I don't know, you plant in the spring, and then you harvest in the fall, and you replant. It could go on a while. Current assets, again, we're starting to understand what they are, and they're just showing you the presentation on the balance sheet. These are real numbers. These numbers are in millions, and these are actual numbers for Southwest Airlines. I'm sure some of us have flown Southwest Airlines. So that number 1680 translates to 1 billion with a B, $1,680 million. That's a nice bank account. And then they have some short-term investments. Maybe they went out and bought some stock. And then they have accounts receivable and inventories, okay? Prepaid expenses, the total, $4,498. And notice that little blurb on the bottom. Companies list current asset accounts in the order they expect to convert them into cash, in the order of liquidity. Review question. Cash and other resources that are expected to be realized in cash or sold or consumed within a year are called current assets. I bet we all got that one right, huh? Current assets. Talk about long-term investments, okay? Long-term investments. Here you bought stock, and you intend to hold that stock for quite a while. Or you bought a bond, a 30-year bond, and that bond is going to pay you interest every year for the next 30 years. Well, that was a $100,000 bond. That $100,000 is a long-term investment, and it will be shown as such on your balance sheet, long-term assets. Long-term assets such as land or buildings that a company is not currently using in its operating activities would be fixed assets. And you might have a long-term note receivable. You might make a deal with a customer, depending on your industry, where the guy doesn't have to pay you for 2 years. And we'll get in some problems like that later in the course. And here's the presentation. You're just going to see a category called long-term investments, not too much to it. Let's talk a little bit about fixed assets. We'll be doing a lot with this. We have a whole chapter just on fixed assets, huh? Assets with long useful lives, currently used in the operation. That's important. If you have an asset and suddenly you don't have a need for that asset, it's not going to do you any good anymore to have that asset. You have to write that asset off as a complete loss and take it away from the financial statements. Maybe it's a machine you bought 30 years ago to make fax machines. You know, nobody uses fax machines anymore. It includes the land, the buildings, the equipment, and the cost is going to be allocated to future years in the form of what's called depreciation expense. And there's an account we're going to talk about called accumulated depreciation, the total amount of depreciation expensed thus far. And again, this is just a warm-up when we get into detail, details. I'd like you to take a look at this. Here is a very typical presentation. And this is from Cooper Rubber Company, and this is in thousands. So that 47,767 number translates to 47 million. It's in thousands, so you just add 3 zeros. So they have 47 or $48 million worth of land, building. They have a ton of machinery and equipment. And that's what you would expect, I would think, for a tire manufacturer. They probably have all kinds of machinery and equipment, grinding rubber, bending it, melting it, processing it. And they have fixed assets in terms of molds and cores. So you add that up and you get that number you see there, 2,297,838. That is the original cost of these assets. That's what we originally paid for them. And everything on your balance sheet goes there at the original cost. we're allowed to depreciate them over a period of years. And thus far, this company has depreciated 1,433,000. If we subtract that from the original cost, we get something called net book value, net property, plant, and equipment, net book value. Intangible assets, no physical system. It's intellectual property. Goodwill, we're going to talk about. Patents, copyrights, that protects authors of printed material. Trademarks, the McDonald's logos. You can't open up a restaurant on the Mesa across the street from McDonald's and hang out two of their logos with just a slight difference. No, that trademark protects them. Also, franchising is something else that would be intellectual property. Sometimes intangible assets are reported as other assets. Okay. And let's see what this company has. Walt Disney. We're back to millions again, huh? So that top item there, character, franchise, intangibles, that's $5 billion. $5 billion, whatever. I'm not even sure what that is. Character, franchise, intangibles, and copyrights. I guess it's all the money that they spent to develop a character like Goofy or Cinderella or somebody. And they've got different items here. They've got other amortizations. So there we go with trademarks, licenses, intellectual property. I'm just going to talk about goodwill for a moment because that's going to come up later in the course. Goodwill is simply the amount you paid above what the business is worth. You want to buy my business, huh? And to you, my business is worth $1 million. It's not worth a penny more than that. But you paid me $1.5 million. Why did you do that? Because I said, I want $1.5 million. I will not accept an offer of $1 million. And I held firm. And you think my business is lucrative enough where it's worth $1.5 million. And you've got the resources to build that business back up into a $2 million, $3 million business. Patents and copyrights are intangible assets, intangible. Assets section of the classified balance sheet. Baxter Hoffman received the following information. Okay. Prepare the asset section. Well, everything here, let's take a peek at it. Prepaid insurance, that's an asset. Inventory, cash, equipment, accounts receivable, trademarks, debt instruments, accumulated depreciation. All of these are assets. So the question is, prepare the assets section. And remember, we start with the current assets. What are the current assets? Prepaid insurance is a current asset. Inventory? Inventory better be a current asset. Otherwise, it means you're not selling it for a whole year. Cash is a current asset. Equipment is fixed asset. Accounts receivable, current. The last three you see here are fixed. So we need to set up these four guys in order of what? Liquidity. So I would expect to see cash, accounts receivable, inventory, and prepay. Let's see. Cash, accounts receivable, inventory, prepaid. So your current assets total $7,600. And then we're going to have a section for long-term investments, which you see here. Property, plant, and equipment, which is another term for fixed assets. Equipment, 10,700 minus that accumulated depreciation number gives you the net book value. And this company has trademark protection. Nature of current liabilities. Obligations you have to pay in a year. Accounts payable, salaries and wages payable, notes payable, interest payable. These are the guys that you're going to pay in a year. Any current year maturities of long-term obligations, okay? So I think we're pretty clear on what a current asset and a current liability represent. So here they're showing a typical listing. You start with accounts receivable, and then typically you'll see accounts receivable, accounts payable. You start with accounts payable, and then after that, you might see notes payable, which is different from accounts payable. And then you have the accrual, something called accrued this, accrued that. Whenever you see the word accrued, that means it's a liability, accrued. And you're going to do a lot with accruals shortly. And then income taxes are always due within a year. Total current liabilities, 19,310. Long-term liabilities, well, you don't have to pay these for over a year, okay? So let's see what we've got going here. Bonds payable, mortgage payable, long-term. Lease liabilities, that's a good one. You might lease a machine for the next 5 years. Pension liabilities, pension. Right now, I collect a pension from where I used to work. I'm one of the last people who gets an actual pension. You guys aren't going to get pensions in the workforce. They're kind of gone. So my advice to everybody is invest as much as you can in the company's 401k plan, even if it hurts. Long-term liabilities, bonds, deferred income taxes, long-term liabilities. Which of the following is not a long-term liability? Well, I think we can pretty eliminate bonds payable, current maturities, and what is not a long-term payable? I would hope the answer is B, certain maturities of long-term debt. Bonds payable, we're assuming that that is a long-term payable. That says long-term. Mortgage payables, long-term. The reason the answer is B is that if you've got a 30-year mortgage, the amount that you owe on that 30-year mortgage in the first year becomes a current liability. On your financial statement, on your income, on your balance sheet, you're going to actually see a line that says mortgage payable, and then in parentheses, current portion. And then the long-term portion would be the remaining 29 years. And that's what they speak of. I also don't like the questions where they ask you what is not something. I always stumble on that for a second. Stockholders' equity. Remember, we're talking about two components. By, when we get to chapters ahead, there'll be other components. Common stock retained earnings. This person started a business by issuing stock to the public, as opposed to in accounting 110, where businesses were started by people putting their own cash into the business. You can still have that here, but typically in accounting 230, businesses raise money through what's called equity financing. They issue stock to the public. So that becomes their equity. And then at the end of the year, if they have income, that goes into equity, only it goes into a different account called retained earnings, okay? Balance sheet classifications. Okay, we've been over this a little bit now. Current assets, long-term, the fixed assets, intangibles, and then you have the current liabilities, long-term, and equity. So what they're saying here on the balance sheet that we're looking at in this chapter, it's got 7 subtotals. Match each item to its proper balance sheet classification. If the item would not appear on a balance sheet, use NA. Let me take a look at this real quick. Did they already give us the answers? Let me look at this. Yeah, it looks like they just popped the answers in there for us. Salaries and wages are always a current liability. Employees don't go a whole year without getting paid, right? Unless you work for Donald Trump, but I digress, okay? Investment in real estate. Real estate is long-term. Unearned service revenue. Let me just tell you what unearned revenue is. That is cash you receive in advance of doing anything for the customer. A lawyer. You go to a lawyer and you say, I want to have you draft my will. The lawyer said, okay, give me $1,000 right now, and I'll get started on it next month. That $1,000 in cash is not income to the lawyer. It's a liability, believe it or not. It's a liability called unearned service revenue. Only when the lawyer does something for you does he get rid of that liability and put it into income. Short term, you see the word short term, you know it's current. Due in 3 years, you know it's long term. And we know accumulated depreciations with the property and equipment. Revenue, huh? That's not on the balance sheet. No. No expenses or revenue go on the balance sheet. None. Interest payable does. Goodwill, intangible. No depreciation expense, retained earnings, equipment. Okay, let's get into something hopefully a little more interesting here, a little more challenging, and very typical things that companies do. We're going to talk about measurements of what's called profitability, liquidity, and solvency. We're going to take the income statement for a company, and we're going to take its balance sheet at the beginning of the year and its balance sheet at the end of the year. And we're going to pick out different metrics and measure them to see how the company is doing. We're going to do some ratio analysis, and which gives you the mathematical relationship between one quantity by another. Note that last sentence. It says a single ratio by itself was not very meaningful. That's very true if you're comparing two companies in the same industry, but one is much bigger than the other. So your company might have $1 million in this ratio that you just calculated. The other company might have 10 million. So it's not fair to compare the two of them. We're going to look at the ratio, the actual percentage, and see what that is. Ratio analysis. Profitability, liquidity, solvency, excuse me. It's good whiskey. Profitability, measure the income or the operating success. Liquidity measures the company's ability to pay its current debts right now. And we went over this a little bit in chapter 1 when we talked about current assets minus current liabilities gives you the working capital. And then solvency, you're talking this ability to survive over a long period of time, okay? So let's see what we got here. Use this income statement. They're giving us 2 income statements. So we might be comparing 2 years together or something. The sales of this company, sales in 2016 were 39.5, and they stayed almost exactly the same, not much growth there. But they knocked $1,000 off of the cost of goods sold. So that's a good thing. And otherwise, their numbers are pretty much the same from year to year, at least these 2 years. Earnings per share. Earnings per share. Any of you who are interested in a particular company, you might be interested in buying the stock of Coca-Cola, but you're going to make sure that Coca-Cola checks out to your satisfaction. So you're going to come up with the earnings per share. It's simply the net income divided by each outstanding share of stock, okay? Net income divided by the outstanding shares, the earnings per share. If you ever watch the news and the business person comes on, or you're flipping the channels to CNBC, you might hear the guy go, well, Kimberly-Clark today announced an EPS of $2.05 a share, which beats the forecast by 5 cents. And as a result, the stock rose. Earnings per share, very important metric. Earnings per share. Now, what's our little formula? Earnings per share equals net income divided by the average shares outstanding, okay? Net income, which they're giving you here, 1228, divided by the common shares outstanding. The way you get that number is you take the number of shares outstanding at the beginning of the year plus the shares at the end of the year divided by 2. That's all you're doing. So net income divided by the outstanding shares gives you the earnings per share, the EPS. Notice that first, though, they're subtracting what are called the preferred dividends. Preferred dividends. You have something called preferred stock, and preferred stockholders get paid before the common guys get paid. So you want to take out the preferred dividends. Earnings per share. Let's see, Stone Land reported net income of 26. They had sales of 400, and they're giving you the average. Preferred stock dividends with 2,000. Well, it looks like they're giving us some stuff we don't need. So what's our formula? Net income is 26,000 minus the 2,000. Minus the 2,000 gets us down to the 2,000 for preferred dividends, gets us down to 24,000. 24 divided by 6 is 4. If there's a God in heaven, the answer is A, okay? There we go. And here they're showing you two balance sheets side by side because we're going to need them in some of these measurements. You might need two income statements. You might need two balance sheets. And here we go. Look at the size of this thing, huh? A lot of current assets, equity, common stock. Okay. All right. That's fine. Let's do a few metrics dealing with liquidity. And we've already done this in chapter 1. Liquidity, the ability to pay your current liabilities right now. Okay. Investors look at this metric, this measurement very carefully. If you don't have enough current assets to cover your current liabilities, that's not a good sign. Technically, you're kind of out of business there. I mean, obviously, you're not out of business, but in a way, you are, because you can't pay your current bills. So you're going to have to figure out a way to reverse that situation. Current assets minus current liabilities gives us something we call working capital. What's the working capital? Current assets minus current liabilities. So Best Buy had working capital of 3 billion, that's a B, 3 billion, 394 million in working capital. And then they're showing you the current assets, current liabilities. Best Buy. Let's take a peek here. Current assets minus current liabilities equals working capital. But again, using dollars to compare companies of different sizes can be misleading. So we're going to not talk in terms of working capital. We're going to talk in terms of the current ratio. The current ratio. We are going to take the assets, the total current assets, and divide them by the current liabilities. And what they're doing here, they're showing it for Best Buy for 2 years. So the numbers that they gave us over here, the 10,516 and the 7,122, you divide it out. It's $1, let's say $1.50 to 1, which is a nickel better than it was in 2016. But not as good as one of their competitors, H.H. Gregg. For every dollar of current liabilities, you got $1.48 of current assets, which means that if you had, say, $1,480,000 and you paid everything off, you'd have $480,000 left over, okay? So the higher the number, the better, except you don't want it to be too terribly high. If you've got 2 to 1, that's good. 3 to 1 is good. But when you start going up to 5 to 1 or 7 or 8 or something like that, the argument is you're hoarding cash for no particular reason. You can't do much with cash if you're holding it. The interest rates right now are terribly low. So if you've got a 10 to 1 current ratio, it might mean you're missing some wonderful investing opportunities. Build another factory. Hire some people, do some research, develop a new product. Solvency, we're talking long-term, the ability to pay interest as it comes due and repay the balance of, this is your long-term debt over a period of time, okay? Measures the ability to survive. Some users evaluate solvency using a ratio of liabilities divided by the total company's equity. This is called the debt to equity ratio. The lower, the better. Obviously, in a perfect world, you'd have no debt, but companies certainly have debt, and they want debt because if your company's growing and you need money, you want to be able to borrow it wisely. So debt is not a bad thing. It's something that you just need to manage carefully. So let's take a look here. Debt to assets ratio. Look at the formula. Total liabilities divided by total assets. 9147 divided by 13,856. Best Buy is 66 and 68, which is a little bit better than H.H. Gregg. That ratio means that every dollar of assets was financed by 66 cents of debt. And this next slide, I think, is interesting, where they show different companies, I believe. Look at this. Debt financing differs greatly across industries and companies. Here are some debt to asset ratios for some big companies. Google has very little debt to assets. And then Nike is higher, 41. Microsoft. Look at General Motors, though. They, the car manufacturer, 74% debt to assets. For every asset they have incurred 74 cents of debt. But in the auto industry, that might be the norm. I don't know. It's just that some companies are in a situation where they're comfortable working with big debt and actually can't survive without doing that. When debt is good. When debt is good. In my personal world, debt is not good. I always pay off my stuff right away. Cash provided by operating activities. Cash flows. Chapter 12 in your book, or I think it's chapter 12, is all about preparing the cash flow statement. One of the most important financial statements prepared every month. It shows the cash flows from investing, financing, and operating. Operating is the one we want to really look at. That's the one that's germane to what the company is doing as far as selling and marketing its product, huh? Cash provided by operating activities fails to take into an account that a company must invest in new property, plant, and equipment and must maintain dividends at current levels. So what they're saying there is that you have other cash flows besides operating. So we're going to talk about what's called free cash flows. Okay, this is going to be your total cash provided by operating activities. And then we say to ourselves, geez, we need to set aside a certain amount of money for capital spending. We got to go out and replace that factory machine, that big expensive stamper. We want to continue to pay cash dividends to our shareholders. So that's kind of a set aside. And let's take a peek at it. MPC produced and sold 10,000 personal computers, and it did its cash flow statement, and it said our cash flow from operations was a positive number, can be negative, was a positive $100,000. They're going to invest or have invested in equipment, which is investing cash flow, and it chooses to pay $5,000 in dividends, which is financing. So the free cash flow would be your total cash from operating activities minus these two categories. It's not the total cash less these expenditures, it's the cash flow from operations. Let me move along here. Wow, here they're giving us a whole bunch of information. They're giving us the current assets, total assets, current liabilities, total. We got all kinds of good information here. They probably want us to do something with it. So let's see. Compute the earnings per share. Earnings per share. Do you remember the formula for that? Earnings per share. The word per means divided by. Earnings divided by the average outstanding shares. So let's see what we have here. Let's see if we can find their net income. Their net income for 2022 was $100,000, right? $100,000. The shares at the beginning of the year was 60, and at the end of the year, they were 120. So 60 and 120 is 180, divided by 2 is 90. So your answer is going to be 100,000 divided by 90,000. Comes out to like, I think it's $1.11, if anybody wants to do the arithmetic. 100 divided by 90. So that's how we get the earnings per share. Let's do 21. Here, the income was 50,000. The outstanding shares were 40 and 60. So the average outstanding shares were 50,000 shares. So 50 divided by 50 means $1 per share. $1 per share earnings. And when companies make these announcements, if they miss what they forecasted, the stock market tends to panic a little bit, and the stock takes a hit for a little while. So companies look at these metrics like crazy. The current ratio and the debt to assets ratio. Current ratio. Current assets are 88, current liabilities are 40. In 2022, here it's 60 divided by 38. I don't know why they don't give us the numbers there, but I think we know what the current ratio is, huh? Current assets divided by current liabilities. In this case, it's 88 divided by 40. So that might be $2.25. I'm just guessing. And the other one, current assets divided by current liabilities, 60 divided by 38. It's about 45 or something, 0.45, okay? Then they want us to talk about debt to equity. Debt to equity. We are going to take the net income and divide it by the total assets. Net income in 2022, 2022 was $100,000. Total assets are 400. That's 25%. 25%. It means that they're financing their assets at 25 cents. They have 25 cents worth of debt for every dollar of assets. Whether that's good or not, I don't know. We saw General Motors was carrying 74%. That would be much higher. Debt to equity. I got to fix these slides and put the numbers in. It seems silly to put a blank screen up there. Let's compute the free cash flows, huh? What is free cash flow? The formula you need to understand is cash from operating activities minus dividends minus capital spending. So that's what we have here. We have 110,000 minus the dividends, minus the 10 and the 5, minus the capital spending. Capital spending means the big ticket items. So that would be what, 100,000 minus divided by 45, 50, 60, it'd be about 1.4, something like that. And here's the one where they do show us the solution. Free cash flow, 110,000 minus 45 minus 10, because you got to worry about the preferred dividends too. Free cash flow. They call it free cash flow because that's money that the company can use any way they choose. Is it time to build a new factory? Is it time to design a new garment for the fashion industry?
Bob, this is John Hall. Since they did show preferred earnings, do we have to subtract that from the earnings per share calculation? I just noticed that on slide 51.
Yes. Yeah, I went over that a little. I don't know if you hear what I went over. Yeah, the reason you have to subtract it from that metric is because the preferred shareholders get paid before the common shareholder. That's why it's called a preferred stock. In other words, if a company has $100,000 available for dividends, and the preferred shareholders are supposed to get 100, there'll be nothing for the common stock people. So that's why you have to pull it out.
Okay, thank you.
Okay. Standard setting environment. Here we go. We're back to GAAP. Generally accepted accounting principles, huh? A set of rules and practices having substantial authoritative support. Wow, that's a fancy phrase. And that the accounting profession recognizes as the guide, the general guide for financial reporting. And it's determined by different standard setting bodies. Now, the next bunch of slides are going to be a lot of terms that will pop up on the test. So let's just look at them. You're not going to learn them from me just babbling about them here, but I'll get you going in the right direction, okay? The Securities and Exchange Commission. They're the people who run the stock market. They're the ones who set up the rules that they want their companies to meet in order to get your stock listed. To get on the, for example, to get a company on the New York Stock Exchange, you have to have financial statements for the last 2 years or so, completely audited. You have to be of a certain size. You have to agree to a lot of the rules of the SEC. The SEC, if you're interested, started in 1934 under President Franklin Delano Roosevelt during the hardest part of the Depression, the Great Depression. Up until then, there were really no rules on the stock market. Half the numbers made no sense at all, and people were getting cheated all over the place. Hopefully, those days are over for the most part. FASB, Financial Accounting Standards Board. The Securities and Exchange Commission doesn't know anything about accounting. But one of the rules of the Securities Exchange Commission is that the members, the companies, must file certain financial information at a certain time under the rules promulgated by FASB. I'm not going to worry about the next two, okay? FASB, SEC. Generally accepted accounting principles are the standards and rules that recognize the general guide for financial reporting. The rules can change. Just since I retired about 12 years ago, the rules changed in regards to how you report the gain of a sale of a fixed asset. The rules have changed in terms of how companies handle gift cards. So there's always things changing that you got to keep up with. FASB, qualities of useful information. You see the word relevance, faithful representation. These are definitions from the world of GAAP. They have very specific meanings, and on your test, inevitably, you might get asked about some of these, okay? A true or false question, okay? Let's look at the one called materiality. That's the one I like. A company's specific asset. Any item is material when it's big enough to maybe influence the decision of an investor or creditor, okay? The auditors are checking your inventory, and you counted $1,800,000 in your physical inventory. And the auditors, they went out and counted, and they came up with $1,790,000. Well, that $10,000 difference is probably not material, and the auditors would sign off on it under the heading of not big enough to worry about. Materiality, is it material? If we omit this information, will it mislead an investor or creditor? And in that case, no. And auditors are always making that judgment if it's material or not. Different words. These are just terms now that you got to review in your homework and reading. Relevance, meaning is it important? Is it worth knowing? Does it make a difference? Does it have predictive value? Can't even read that word. Confirmatory value, confirms it correct. Relevance means, is it worth reporting, basically. Faithful representation means that the auditor is giving the complete information, and he's neutral. He's not biased toward one position or another, and it's free from error. You can faithfully, you can have confidence that it was faithfully represented. Look at all these other terms. Comparability. Two companies using the same accounting principles. Regarding accounting principles, there are sometimes choices that each company can make in terms of which principles they follow. One company might depreciate their assets completely differently than another, or they might value their inventories different. So comparability is something important. Verifiable, you better be able to very tangibly verify what you're talking about, and it better be understandable. I don't know if any of you have ever heard of Enron Corporation, which was the biggest and most disgraceful bankruptcy in American business history. And that company went bankrupt because for many, many years, they were handing out phony financial statements. And the stock just kept going up, and oh, they were doing great. And then a young writer named Bethany McLean for Fortune magazine, she interviewed the president of the company. And she was a CPA, she knew her stuff. But after a week listening to them present how they do things, she still didn't understand what they were doing. And she wrote an article in Fortune magazine, I believe. The title is, and you can find this on the internet, "How Does Enron Make Its Money?" And at that point, the pin went into the balloon. People started to look seriously. It turns out it was all a shell game. Terrible. It was such a bad scandal, people died. And, you know, I could talk about that one time. Anyway, I digress a little bit. It's got to be understandable. Consistency. Consistent, you're using the same principles yourself year to year. Comparability means comparison with another company. Consistency, you're comparing yourself from year to year, using the same principles. And information's got to be timely. You know, if you tell the president of the company that you have $1 million available to invest, but you don't tell them for 6 months that million could be gone. In other words, at the beginning of the year, at the end of the year, you had an audit, and the auditors determined you had $1 million, but you didn't tell the boss for like 6 months. By then, that money was gone. Timely. We assume we can turn the numbers into dollars. That's all with that monetary unit assumption. The economic entity assumption. It means that any economic venture, if you will, can be separately identified and analyzed. That's what a company is. Here's a word I love, periodicity. It means that the life of a business can be divided into artificial time periods. In other words, you can chop a business up into 1 month. Our company closes the books every month, or it could be the quarter or a year. And then the going concern. The auditors, after they do their audit and everything's fine, if the auditors think that maybe you don't have much of a future, they have to report that. Otherwise, they state you are a going concern. And I'm just going to finish up with just a couple more of these. Historical cost. Everything on your balance sheet is costed at what you paid for it. If you bought a machine for $1,000 and that machine suddenly had a value of $3,000 for some reason, you're not allowed to show a gain on the increased value of that machine. You can only show that gain when you sell it. Fair value. Full disclosure. You must disclose all circumstances and events that would make a difference to financial statement users. You know what would be a good example of that? A pending lawsuit. Someone is suing this company for millions and millions of dollars, and you get together with your lawyers, and the lawyers come to a consensus that scenario A, they got us by the chops. We are probably not going to win this lawsuit. That means that you immediately record the loss at that point. If they're suing you for 2 million and you think you can settle for, say, 500,000, you would have to record a $500,000 loss immediately. If your lawyers tell you, we don't know, this case could go either way, well, then you don't have to write it off, but you have to disclose it in the notes. And if it's a very frivolous lawsuit, you don't have to do anything. Cost constraints. What the heck is that? Accounting standard says where the cost the companies will incur to provide, yeah. Yeah, you're not going to spend $1 million to verify a $100 item is basically what they're saying. You weigh the cost to do get the information against whether the information is worthwhile having. And here they just go into these ones that we just went over, the terms. And this is kind of the duller part of the chapter, if you will. But there are a lot of questions here on the test coming from these terms, okay? The primary criterion for accounting information, it's got to be useful. Got to be useful. And our class just ended, okay? Anybody have any questions, any comments or anything? Don't speak up all at once. Okay. No comments, no questions. RJ, are you there?
I'm right here.
Okay, do you want to call the meeting to an end, RJ?
Sure, why not? The meeting is officially at an end.
Thank you very much. So we can go now. And did you get that little thing I sent you through the discussions, RJ?
Yeah, I did. I played the link for the Slipknot
Yeah.
piano.
Yeah, you get
It was
you
really
get the
nice.
sense of that piano technique I was talking about?
Uh-huh. Yeah, I saw that. I think I
Yeah.
know. I think I
Okay.
know what you're talking about now.
Okay. All right. Well, take it easy, everybody. We'll see you on Friday, okay?
Bye.
Thanks, Bob. Bye.
Bye-bye.
Thank you.
Thank you.
Thank you.